Hi, I'm Max Jong. I'm Managing Director here at Risk Management Advisors. Excited to talk about general liability coverage specifically today. We get a lot of inquiries from our clients and prospects talking about the pain points relative to their general liability coverage. Every year, the broker comes back and offers up more limited solutions that don't fully suit their needs. And frankly, a lot of the issues that they're contending with has really nothing to do with them. We have clients that have very little loss history within a number of years, and the pain points that are happening within the general liability space has a lot to do with what's happening in the marketplace. There are nuclear verdicts that are occurring where juries are affording eight-figure judgments to plaintiffs that ultimately are paid by insurance companies. And so that massive loss and also just social inflation and how much more things cost, that drills down into a premium that you ultimately have to pay. So our clients that are mid-market, they're sizable, and they're very serious about managing their risk well and having great safety protocols, they get very frustrated. So one of the very common lines for our hundreds of clients that incorporate general liability into their captives is to be able to essentially capture underwriting profit that would otherwise go to a third-party commercial carrier. And there's a way that you can sort of dial the amount of risk that you're willing to take so you don't bet your balance sheet of your company on something that potentially could happen down the road. So one of the things, a very common practice for us is to suggest looking at using a captive insurance company. And most of you watching this video have an understanding that a captive is essentially a bona fide insurance company that's been set up specifically to insure the risks of your operating company or a series of related operating companies. What we specialize in primarily would be in single parent captives. So as opposed to a group captive in which you have a lot of other participants, this is a captive that you would own and control. You're the sole stakeholder. You get to appoint your board and your officers and hire service providers like us that you ultimately can control how this captive operates. There are a lot of different motivators to setting up this structure. What you'll find is that underwriting profit is a big motivator. So in speaking with a lot of clients, they've gone a number of years paying, multi-six, seven-figure premiums annually and have a de minimis amount of losses. And so if they're adding up what they've paid over time and stacked it up with the amount of losses that the carrier has had to pay, they realize that they've been a very profitable company for that particular insurance entity. So when you have your own insurance company, the policies are issued by your entity, which is part of your balance sheet, and all of that underwriting profit inures to you. Some of the other benefits that our clients have experienced is that they have the ability to craft insurance policies that are more suitable for their business. They can decide to increase or decrease limits that is suitable to them. They can increase or decrease deductibles. And also, they're ultimately taking advantage of this structure that a lot of very smart people like a Warren Buffett have discovered, which is when you now become the house, you now are an insurance company, you take in premiums, you can invest those premiums, and all of that upside on the investment is retained within your own captive. And Congress has created a lot of favorable tax treatment within these insurance companies. So the premiums coming in can potentially be tax deductible. The growth of the captive potentially can have some tax deferred benefits. So all of those reasons give a lot of folks motivation to set these things up. So how do our clients get this done? A very common way to approach this would be to have a high deductible program. So let me describe how that works. There are situations in which you are a very sound practitioner. You have solid safety protocols, you take it seriously, and you have a very, very low or zero loss history. If you go back to the insurance company and say, we're willing to take a much higher deductible, maybe $250,000 or $500,000, of a claim, then that carrier, because you're taking on more risk, might give you credit and a reduction in premium over time. And so what you could do is to have a high deductible type of program, pay a lot less to a third-party insurance carrier, which is good. And then because you've retained a lot more risk, you can have your own insurance company issue what's called a deductible reimbursement policy. So essentially, you are taking on that risk instead of on your balance sheet, you're formally shifting it to your own captive. And so by doing that, paying sort of two separate premiums, you've got less going to some other third-party carrier. You've got a healthy amount going into your insurance company that is available to pay any reimbursements to your company if you have to pay a deductible. Now, everyone worries about, boy, what if something really bad happens? And anyone who's in a business for a while can tell you that that will happen here and there. So what our clients have experienced over time is that they're going to have a bad run in any given year. But over a number of years, there's highly likely a possibility that you're going to have solid underwriting profit. And under that construct, you're going to grow your surplus within your insurance company and have a much larger capital base to potentially take on more risk in the future, or actually layer on other insured lines, which is very common for our clients. And so that is a well-worn path for a lot of our clients to be able to enter into a captive space and capture that type of upside. A less common approach would be for some of the larger clients. And by larger, I mean you're paying $1 million, $2 million plus per year in general liability premiums. And part of the challenge here is that when you're dealing with general liability and third-party risks, we have counterparties that we have to think about. You might have a bank, you might have a lender or a customer, or a vendor who requires that you carry not just general liability, but it's got to be with a carrier that has sufficient ratings by a company like AM Best. It's got to be of a certain size. They may have limitations on limits or deductibles. And so when those brackets are put around you, you do have alternative options to engage what's called a fronting carrier. And a fronting carrier is essentially an insurance company that's already operational in the state that you're in. They do satisfy all those boxes that your lender may require in terms of size and rating and everything else. And that fronting carrier will be engaged by you to step out front. So they're going to issue policies on your behalf. And you, as a captive participant, becomes a reinsurance partner. So you essentially step behind this fronting carrier and take on some level of risk within that policy. And so that only works if you are of a sufficient size, but we've seen it work very well. So that is also a very healthy alternative within the general liability space. Now, I'd like to give you a couple of examples. Having been around for a while and having the number of clients that we have a lot of success stories. One in particular is we have a security company that's quite large, and you can kind of imagine that, providing security guards in a lot of different locations, that they would probably have some frequency of general liability losses, which exists. But they took the leap. They did the high deductible option. They pushed up their deductibles to $500,000. And they also rolled in workers' compensation as a high deductible option. So as a function of sort of blending these two, they've experienced that, yeah, they've had some bad years, but over time, the amount that they would have otherwise paid a third-party commercial insurance company, they were able to capture and retain within their own captive. And so it's been a very profitable endeavor for them. What we've also discovered for them is that the carrier that they've been working with, because they've been with them for so long and they feel like they know this particular client fairly well, that carrier has offered to be a fronting carrier for this client as well. So there is some thought in terms of a pivot from this sort of high deductible program to having the existing carrier step out front and having the client be able to take on more risk appropriately. So as clients mature and grow, having that optionality becomes really, really nice. One other actually new prospect we're talking to is really interesting, and they're contemplating something that we've done for a number of other clients. These folks, they are the guys that you rent from if you want a guided tour on a jet ski or a four-wheeler. And as everyone knows, that type of excursion has become really popular. So they are great operators. They have fantastic safety protocols. Their processes are top-notch, and their loss history is nearly zero. So their current insurance essentially charges a per ride, per rider fee that is paid to this carrier to the tune of hundreds of thousands of dollars. And for one particular company, it's going to be pushing $1 million a year. All frankly underwriting profit to that insurance company. So they approached us, and it looks like for them, they don't have necessarily a requirement to have a carrier that's rated or of a certain size. So the work that we're doing now is to build a program in which a captive of theirs is essentially going to take on that risk. And so for this particular client, instead of offering insurance to their customers, they're going to make some amendments to their rental agreement that says if something happens, the company is obligated to pay X, which is not atypical, and it'd be very similar to the current insurance construct. But the client's own captive is going to be paying a premium. It's going to be receiving a premium from that operating company, which is, again, probably in that $500,000 to $1 million range. That's ultimately going to be upside to the client. That's pure underwriting profit, found money for them. Now, there is some downside relative to the risk that they're going to take. But when you think about literally a new line of revenue that's nearly all underwriting profit for these particular clients, it moves the needle. So that's why we get excited, because these types of programs in the right setting could have a ton of upside for our clients. So hopefully that gives you a better sense. Would love to connect with you all about this particular topic and others. Feel free to reach out to us either on our website or directly via phone.